A Roth IRA is a really flexible and powerful retirement savings tool. It can help you get tax-free income in retirement, and it can help you prepay your taxes if you think that's the right thing to do. But if you're not entirely clear on what happens when you take money out of those accounts, that's what we're going to talk about here. So we'll figure out if you can get tax-free income or what happens when you take early withdrawals from a Roth. As a quick refresher, the question is, do you want to pay taxes on this seed that you plant or on the tree that eventually grows? And that's an analogy for your Roth IRA. When you pay taxes on the seed, you're paying taxes on the investment that you put into the account up front, and the idea is that you won't pay taxes on the eventual tree or the amount that it grows to. Ideally, over many years, your investment will grow to be quite a bit bigger, and you can take that money back out. You have a pool of funds to draw from, tax-free in retirement. Again, if all goes well. There are 3 factors that can help you figure out if you're going to pay taxes on a Roth withdrawal or an early withdrawal. One is the type of money you're taking out. So those regular contributions that you put in, if you're making the $6,000 or $7,000 per year contribution, those are your regular contributions, and you can take those back out of the account at any time without taxes and penalties. That's what makes a Roth really flexible. There may also be some earnings in your account. So that's a different type that would be on top of the contributions you've put in, and that's where we may potentially have some taxes. We're going to get into that in a minute. Your age is also important, so the question is, are you over or under the age 59 and a half? And then we also want to know, have you had your Roth account open for at least 5 years before you take that distribution? So let's go through those types of money. Again, we have the regular contributions, and just here's a visual representation of it. Let's say you put in $6,000. This is just 1 year's worth of contributions, for example, and over some period of time, it gained $600 of earnings, or 10%. Well, that $6,000 you could pull from. It's kind of like pulling from the bottom of your stack there, and you would not owe taxes or penalties on that. In fact, the IRS sets an order of withdrawals, and that says that that money is going to come out first. And again, it's tax-free and penalty-free money. Next, we have the earnings or any growth on your contributions. And that's where we need to pay attention to your age and the amount of time you've had your Roth account. One other type of money or bucket of money you might have is conversion money. So if you converted a pre-tax IRA or a portion of your pre-tax IRA to Roth so that it would be ideally tax-free later, that is a little bit different money type, and we're going to talk about how that works. But each conversion is treated separately. So if you've been doing partial Roth conversions, doing a little bit each year, then each of those is going to be treated separately with its own 5-year rule. And you might wonder about Roth 401k or Roth 403b savings. How do those fit into all this? Well, what usually happens is clients, at least, typically move that money into a Roth IRA. They don't always do that. You don't necessarily have to. And there are some pros and cons. I've got videos that discuss that. But if you decide to take control of the money, maybe you can get more investment options, maybe you can get lower expenses, you can move the Roth 401k into your Roth IRA, and then take your distributions from there. If you're going to go that route, it's a good idea to open up a Roth IRA if you don't already have one, and that way you can start the 5-year clock ticking so that when you do roll the money in, the account has been open for 5 years. It's important to not only open a Roth, but also fund it. So you can do that with a low-cost investment provider or something where you can just make a small contribution if that's all you qualify for. Either way, you want to get that clock ticking. We're getting a little complicated here, so the thing to know is that if you just want to make it easy, the way to get those tax-free withdrawals from a Roth is to satisfy 2 requirements. One is that you're over age 59 and a half, and number 2 is that you have had a Roth open for at least 5 years before you take that withdrawal. You don't always have to do that, but that's the easiest way to just get the tax-free withdrawals and satisfy the requirements. Now let's look more closely at your age, because this is a really important thing to potentially avoid taxes and or penalties. So there's a lot packed into this slide here. I'm going to include a link or two in the description that help you make more sense of this so that you can dig into these details yourself later and double and triple check everything. When you're over age 59 and a half, and again, you've had your account open for at least 5 years, then you can take those earnings out, not only the contributions, but the earnings on top of it. You can take that money out without taxes and penalties. That's what's called a qualified distribution. But if you don't meet that 5-year rule requirement, then you may have to pay income tax on the distribution, or at least on the earnings portion of the distribution. So there's not a 10% penalty tax, but there may be income tax. When you're under age 59 and a half, but you have met the 5-year rule, you're going to pay income taxes potentially on that earnings portion. And if you haven't met that 5-year requirement, then you can have income tax plus an additional 10% penalty tax. Like I said, this can get really complicated with a couple of different moving parts. You've got your age and then the 5-year rule, and you've got these potential exceptions that can help you avoid some taxation. A few of those exceptions are listed here. The important thing to do is look them up and make sure you know what they are and stay current on all of these rules, and then communicate that to your CPA or your tax preparer. So if you do take an early withdrawal, they know that you can potentially get an exception applied and reduce the amount you owe. Now let's touch on conversions. Again, if you have taken pre-tax money in a traditional IRA, for example, and converted that over to Roth type money, there are separate 5-year rules for that, and there's a separate rule for each conversion. The reasoning behind this is that the IRS doesn't want people to use Roth conversions as a way to get around the early withdrawal penalties on their pre-tax money. So if you had money in a pre-tax account and you're under age 59 and a half, you might say, well, gee, maybe I can just convert that money, pay the taxes on it, and then pull it out of my converted Roth, and I don't have to pay an early withdrawal penalty. The IRS apparently caught on to that, and so when you are under age 59 and a half, you can still potentially pay a 10% early withdrawal penalty even on the amount you convert. So you paid taxes on it, you might think it's free and clear, but you might still owe a 10% penalty tax on that, so just be very careful. Another question that comes up is often, what if they change the rules? So I go ahead and prepay my taxes, thinking that I'll get a benefit in the future, hoping that that will work out. But what if they pull the rug out from under me and decide to tax those distributions? Anything is possible. What I would say is it's just really hard to predict the future, and trying to get too fancy is often something that can backfire for people. There are several ways that lawmakers could raise revenue for the Treasury. Maybe there's a value-added tax or a consumption tax that's similar to a sales tax that you might pay locally. So you don't necessarily want to just assume that the only way they do that is by taxing your Roth. There's some research out there that shows what would happen if they did decide to try and tax those earnings. So we can say, out of all of the available revenue sources, if the IRS was to start taxing the earnings from Roth accounts, how much would that be? And what you can see is that that slice is actually a really small piece. That doesn't mean it's nothing, so it certainly could be attractive for taxation, but the political price that lawmakers might have to pay if they decided to go down that road could be steep, and the payoff is not necessarily huge. So the question is, will they do that or not? Obviously, we don't know. Anything is possible, but at least at this time, it doesn't look like a huge risk to reward thing for lawmakers. But again, those balances could grow substantially over the years, making it a more attractive source of funds. Just remember the benefits of Roth, and that is that if all goes well, you can potentially pay taxes at a lower rate today. And I've got some videos that discuss the math behind that if you want to look into it. And it's not just your federal income tax that matters with Roth versus pre-tax type retirement accounts. You can also just minimize your income, which can help your tax return, which might cause you to not have to pay taxes on your Social Security income. It could keep your healthcare expenses low. So there are a number of benefits if this all goes well. So if this has been helpful for you, please leave a quick thumbs up. That helps to get the word out to other people. That also lets me know that I'm on the right track. And please subscribe as well. Helps you stay up to date on these things, and again, helps me out just a tiny bit. So thank you and take care.